Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. The segment is brought to you by Red IQ. Turn data into actionable intelligence. Check it out at rediq.com. Now, all of our sponsors, you can always find them at commercialrealestateshow.com. Well, today we're talking about REITs, Real Estate Investment Trust. My guest is Calvin Schnure, and he's a PhD, and he's also Senior VP with Research and Economic Analysis with Nareit. And he's joining us on the phone. Calvin, thank you for being with us, sir.
Thank you, Michael.
So, Calvin, I want to ask you about some of the property types, and let's first talk about retail. It seems like a lot of people are concerned about retail, although it seems when we're marketing retail properties, there's multiple competing bidders, no matter if it's a core asset or something that's a value add, even distressed. So, what do you guys see out there? What's your outlook for retail?
The first thing you have to remind people is when you say retail, there's a big difference between a retail store and a retail property owner. We've seen lots of retail stores that are facing competition from sales on the internet. And this has led to store closures and a number of big bankruptcies. And that's certainly hurt the retail store sector, but that's different from the retail property because there are a lot of other stores that want to come and fill that space. What we've seen in the REITs that own retail properties is after there's a short-term dislocation when a space is vacated, but there are new tenants who are coming back in. The occupancy rate on properties, retail properties owned by REITs, is still quite high. It moved down a bit in 2017 because there were Toys R Us, Bon-Ton. There were a number of large bankruptcies and store closings then. But they got new people to fill that space. And so what that means is the retail property sector is still a good investment.
Yeah, well, it's interesting when you see some of the new uses in some of these retail properties. So does that mean some of the REITs that just focused only on retail are maybe branching out into other sectors?
No, they continue to focus on retail, but there are a couple of particular factors about REIT business strategy. They select higher quality properties in higher income markets, in stable areas, and those are the ones that fare pretty well. There are a lot of shopping malls in the country that are in trouble, but they tend to be older malls in areas that have not had job growth, that may not have a whole lot of income growth, and frankly the whole community is struggling. That's a different type of retail investment than what the REITs do. The REITs try to choose something that is going to have a good store of value and good income growth, and those areas continue to do well, and I would expect them to continue to do well in the future.
Yeah, well, it's interesting you say that because I think retail is probably a sector where there's really a lot of opportunities, especially on some of these properties that you may be changing use or changing tenants. Well, let's talk about office, Calvin. There's a lot of speculation about the office market, having some changes with shared space, co-working, and people using less space per square footage. But it also seems like the shortage of employees, that the recruiting and retention has become so important to companies that they really want nice office space. So when you look at the economy and the jobs and everything out there, Calvin, what's your outlook for the office market and office REITs?
The first thing to keep in mind is that the U.S. economy continues to produce a lot of new jobs, and a high share of that are office jobs, office employment. And ultimately, all of the other factors that you mentioned, whether it's smaller space per worker, whether it's office sharing, whether it's some of these other trends in the industry, those really aren't as important as the fact that job growth is good. Now, we do see some of these other trends, and actually, I will say that the growth of demand for office space, the amount of leased space in the market, has been growing more slowly than overall job growth, which reflects some of these issues, whether it's new workspace environments where you have more common areas, workstations, and less focus on the traditional office around the perimeter. And the office sharing are also spreading, although you think about it, the office sharing, it's not clear how much of a negative that is for the demand for office space, because many of the people who are using that space might not have leased any space at all. They're just saying instead of being from their home or some other crowded place, they're choosing something that is some temporary part-time office space. That's still net new office demand. But overall, these factors that have been taking a little bit of the steam out of the growth of the office market really aren't as strong as the fact that job growth is still good, and you still do see a lot of increase in demand.
Yeah. What about the construction costs? We talked about that in an earlier segment and its impact on commercial real estate, and there's a lot of construction involved in a lot of office properties to build them out for new tenants, and then of course you have the impact on new supply. Is office sector really impacted by rising construction costs potentially more than other sectors?
Well, I would say that office is feeling the same pressures that other sectors do. Many of the materials are the same, whether you're building an office building or whether you're building a residential or retail. The structure is not fundamentally different. And a lot of the skilled trades that are in short supply are the same across all of those. So I would say that this is a common factor across many types of commercial construction.
And Calvin, there's a trend with a lot of tenants and a lot of companies to try to have more flexible leases. Maybe it's from lease accounting of the FASB, maybe it's just from the flexibility and the rise of co-working and kind of stay on top of employment. Is that having an impact on office REITs? I'm sure REITs would love to have really big, strong tenants with very long leases. Any impact there?
There still are an awful lot of tenants who want to sign a 10-year lease because they are expecting to stay in business and they have a solid workforce and they need that space. You do also see others who are looking for shorter leases, and certainly the office sharing companies are in the forefront of pushing for shorter term leases. But ultimately that just means that the property owner needs to keep an eye on how they're going to make sure the space is filled next year or the year after instead of looking out 5 or 7 years. That's a business risk. They're in the business of managing these types of risks, and they've got a pretty good handle on it.
Okay. Let's switch over to multifamily, Calvin. It seems like in a lot of these big cities like where we live in Atlanta, there's been a lot of cranes, a lot of new construction, but for the most part, it seems like these properties are leasing up well, even though the rents are pretty high. What's your outlook for multifamily and the impact on REITs there?
Well, you've hit on all of the factors there. There is a lot of construction, but they're leasing up pretty quickly and rents are pretty high. The apartment market is going to continue to be very firm. When I say firm, I mean you're going to see high occupancy rates, very low vacancy rates, and rents are going to remain high. I'm not sure if they're going to rise very rapidly because one of the biggest challenges facing American households is affordability of their rent, affordability of their housing. And essentially what happened was after the housing crisis, there was a sharp slowdown in how many living units we built, how many housing units. So when I say units, to mean both single-family homes and apartment units. And that means that there's still a big backlog of people who are in a bit more crowded situation. They're maybe roommates with a group or maybe move back with family members when they're at a time in their life when they might have wanted to go out and sign their own lease or maybe even buy their own home, but there just isn't much supply available. And that backlog is very big relative to the annual construction every year. So I would say for 2019, and actually even into the 2 or 3 years in the future, you're going to see very solid demand for any properties that come on the market.
Okay, well, let's switch to industrial. Seems like industrial has just been doing incredibly well. What's your outlook there?
Well, you're right. Industrial has been a star performer, and it's important to keep in mind when we say industrial, this is not like a factory. The growth in industrial is in the logistic facilities that are used to ship e-commerce goods, things bought on Amazon, things bought on eBay. The industrial facilities are essentially the hub for the last mile of delivery. There's been tremendous demand growth. I'm sure everyone is aware of this because we've all bought things on our phone and had it shipped there the next day. How does that happen? It's because there are these facilities that are located near an airport, maybe near highways, and also very close to consumer centers so that you can get the goods to the customers quickly. And the growth of demand for this space has been just as fast as the growth of internet sales. That is very, very rapid. So among all the property sectors, you see industrial has some of the highest rent growth in terms of the space itself, and also they've got very good stock returns. Over the past 3 years, the total return has been almost 22% a year if you invested in industrial REITs. That's a really solid return, just reflecting it's a favorable market.
Yeah, the industrial guys are really smiling today. Well, Calvin, you've been doing this a very long time, and are you seeing commercial real estate become a more favored asset class for institutional investors and then for investors in general as they're looking at all the types of assets they can invest in?
Well, there's always been real estate, and someone has always had to own it and invest in it. And until 25 years ago, most of this was direct holdings by private investors, endowments, pension funds, and so on. And individual investors did not have a whole lot of opportunity because, I'm not sure about you, but I can't go out and buy a 20-story office building myself, or even a part of it. One of the big changes is the growth of the modern REIT industry that went from being a pretty small part of the market 25 years ago to, at this point, REITs own about 20% of the institutional quality investment grade commercial real estate in the U.S. So what does this mean? It means that there's $1 trillion of market cap of equity investments in REITs that are available for individual investors as well as institutional investors to gain an exposure to commercial real estate. Now, why is this important? I know you work with commercial real estate, but I want to just bring this point up again. The investment characteristics of commercial real estate can really help buffer the other risks in someone's portfolio. It helps diversify the portfolio. So an individual who may have some savings and may have a retirement plan, if they're able to put some money into REITs or into a REIT index fund or REIT ETF, that can help reduce some of the risks in their portfolio over time.
Yeah, that's a good point. I've always seen commercial real estate as a hedge against inflation. I know it just seems like a safe bet. So are investors adjusting their allocation for commercial real estate as they see the economy kind of roll along and kind of the stability that commercial real estate has? Is there a higher or less allocation out there for real estate?
These allocations can't switch fairly quickly. I mentioned the $1 trillion of REIT market cap, and you've got like $15 to $20 trillion of total commercial real estate properties. That's the higher quality, mid quality, and everything. And you just can't have huge shifts in that over the short term. So there are some pricing differences. The REITs are doing quite well right now, and that reflects some different pressures in the market. But in terms of overall allocations, you've seen rising allocations to REITs over the past decade or so, but not a whole lot of shift over the short term.
Okay. Well, Calvin, what would you leave our audience with related to commercial real estate moving forward and REITs?
I would point out that there really are no signs that the year ahead is going to be that much different from, say, the past 3 years. And those past 3 years were very favorable for real estate. You had solid macroeconomic growth with consumer spending, job growth, the types of things that give demand for commercial real estate space. And as a result, REITs have had good earnings and capital appreciation, and that's something that's really nice to have in your portfolio.
Good. You make me feel better, Calvin. Thank you for joining us, sir.
My pleasure.
All right. And thank you for joining us around the country. Please comment, please share, let us know what you think, and reach out to us. If you have an opportunity to thank our sponsors, you can find them at CREshow.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com. BOMI International. For facilities and property management education, visit BOMI.org. Buyproxy.com. Your global commercial real estate listing service. Visit buyproxy.com. Red IQ, turning multifamily data into actionable intelligence. Visit rediq.com.